LLCs do not help you save money on taxes. S corporations help you save money on taxes. But do you understand why? Well, during today's episode, I'm going to show you how having an S corporation in 2025 can help you save over $50,000 in taxes. On top of that, we're going to discuss my top 5 S Corps tax saving strategies. And number 5 is so good. It's going to seem illegal, but trust me, it's not. All that plus more on today's episode. What's up, family? Welcome back to another episode of Tax-Free Living, where I teach entrepreneurs just like you how to live tax-free. I'm your host, Carter Cofield, and today we're about to blow your mind with some S Corp saving strategies. And the reason I did this episode is because I came across an article that the average small business owner is overpaying taxes by over $20,000 per year, right? And it is my job, it is my obligation to make sure that that stops happening and that is not you as overpaying taxes. So before we go into these S Corp saving strategies, let's talk about who an S Corp is for. Okay, so if you're a small business owner making more than $50,000 in profit, which profit is revenue minus expenses, if you're a small business owner or a freelancer, right, earning over $50,000 profit in your business, you need to have an S corporation, because an S corporation will help you save on self-employment taxes. Okay, and remember, when choosing your business structure, tax savings should be top of your list, and understanding which business structure is going to help me minimize my taxes and maximize my savings. So strategy number 1 is the salary distribution sweet spot. Okay, so let's break this down, because most people understand, I think they understand this part, but they kind of miss it. So when you have an S corporation, one of the major reasons why having an S corporation help you save on taxes is because it helps you save on what's called self-employment taxes, which, if you didn't know, is an additional 15.3% on top of federal, on top of state. And the reason that S corps help you save on self-employment taxes is because the salary that you pay yourself, you do have to pay self-employment taxes on. But the rest of your money, which is dividends from your business, you do not have to pay self-employment taxes on. So when you set up your S Corp, we need to find the salary that is going to help you minimize your self-employment taxes the most, okay? So now here's an example. Let's say your S Corp has a profit of $100,000, okay? And let's say you pay yourself a salary of $40,000, okay? So that means that the $40,000 you pay yourself in salary, you have to pay that 15.3 self-employment taxes on. But the rest of the money, the other $60,000, completely avoids self-employment taxes, which in this example will save you $9,000 in taxes. Because if you have an LLC and you have $100,000 in profit, you have to pay self-employment taxes on that whole $100,000. But with the S corporation, you get to select the salary that you pay yourself, and the salary gets hit with self-employment taxes, but the rest of it doesn't. And I know what a lot of you all are thinking at home. Well, Carter, if the salary that I pay myself gets hit with self-employment taxes and the rest doesn't, why should I pay myself a salary at all? I know that's what I thought about when I first heard the strategy. Well, the reason you have to pay yourself a salary is that the IRS requires you to pay yourself a reasonable salary from your S corporation, right? In our firm, we dictate a reasonable salary to be anywhere between 30 to 50% of your net income in your business. 40% is like my favorite sweet spot, because 30% is really aggressive. 50% is you're overpaying taxes. So we like to stick around that 40%. So you have to pay yourself a reasonable salary. But what I often see is some people are paying themselves a salary that's way too large. We had a business owner with $400,000 in profit. She was paying herself a $300,000 salary. And so she was overpaying self-employment taxes by tens of thousands of dollars. So we came in, we reduced that salary to $100,000, which saved her tens of thousands of dollars in self-employment taxes. And some of you all are saying, well, Carter, $100,000 is only 25% of her profit. So is that possible? Yes. The more money your business makes, the lower we can push that salary. Because think about it. $100,000 salary is the reasonable salary no matter what you're doing, whether you're doing consulting or have a dog grooming business. $100,000 salary is a reasonable salary across the board. So finding that salary distribution sweet spot is going to help you save tens of thousands of dollars in self-employment taxes. So that's strategy number one. Okay. Now let's move on to strategy number two. And I call this the 401k double dip. Okay. So when you, as a small business owner, you are able to set up your own retirement account, your own retirement plan, right? You can set up a SEP IRA, set up a simple pension plan. But my favorite plan is something called a solo 401k. And as an S Corporation owner, a solo 401k is the best retirement plan for you because it helps you contribute the most money. So let's break down an example. So in 2025, you are able to put away up to $23,500 into your solo 401k plan as the employee. But when you have a S corporation, you are both the employer and the employee of your business. So you could put up to $23,500 as the employee of the business, but you could put up an additional $46,000 as the employer of your solo 401k. So you can double dip being an S corporation owner. So let's do some math. Let's say you paid yourself a salary of $100,000, right? That means that as the employee, you can contribute $23,500. But as the employer, you can match your own contribution up to 25% of the salary that you pay yourself. 25% of $100,000 is $25,000. So with the $100,000 salary, you can put away $47,500 into this plan every single year. But not only that, you also will get a $47,500 tax deduction for doing so if this is a traditional plan. So you save on taxes today while increasing your net worth tomorrow. Okay? And for my business owners that say, well, Carter, I don't want to pay taxes on that money when I take it out in retirement, you can set up a Roth plan, right? You can set up a Roth solo 401k. You can contribute the money, and you won't get a tax deduction today, but that $47,500 will go tax-free forever, okay? And this is a powerful strategy by stacking a S corporation with the solo 401k. All right, now let's talk about strategy number 3. And this is called the Augusta Rule Gold Mine, right? Now, if you've never heard about the Augusta Rule, you must have been living under a rock, unless you're new to this channel, because the Augusta Rule is one of my favorite strategies. And here's the concept. The Augusta Rule will allow you, the business owner, to rent out your primary residence to your business. And you can charge your business rent, and you receive the rental income tax free. Okay, so your business gets the tax deduction, and you receive that money tax free. So you can rent out your primary residence to your business for up to 14 days a year. Okay, now depending on where you live, is going to depend on how much you can charge your business for rent. Right. So if you're living somewhere like, I don't know, Dallas, Texas, and you have a standard, 3-bedroom, 2-bathroom house, you might only be able to rent out your primary residence for $400 or $500 a day. But if you're living in Los Angeles and you have a mansion, you might be able to rent your primary residence to your business for $2,000 a day. But you have to check the rent comps in your area. But let's just use $1,000 a day for easy math. That means that you would be able to work from home, charge your business rent for using your primary residence, which most of you all are doing anyway. And you could charge your business $1,000 a day for 14 days. Okay, that means your business will get a $14,000 tax deduction, but that also means that you will receive that $14,000 100% tax free. So it's like we're legally shifting $14,000 that would have been taxable to a 37% tax bracket if you're a high net worth, a high income business owner, to a 0% tax bracket, right? And this is one of my favorite income shifting strategies. How do I move money off of my business tax return and put it somewhere at a lower tax bracket or at a 0% tax bracket? So as an S Corp owner, you can take advantage of the Augusta rule. And if you haven't done this yet, you need to be doing this in 2025. So now let's talk about one of my favorite strategies, which is having your board of advisors. So let me break this down. So you know how these big C corporations, big companies, they have board of directors. Well, being an S corporation, you can have what's called a board of advisors. And these are going to be people that help advise you on your business strategies. And what's amazing about board of advisors for S corporations is you don't have to pay them anything. Right? They don't have to pay them anything. They used to be people that you trust to give you advice. And your board of advisors can be anybody you want them to be. So what we recommend is that why don't you have your board of advisors be your family members? So your spouse, your children, your sister, your sister-in-laws. You can have your board of advisors be your family members. And that way, number one, you're bringing the family into the fold of the business. It kills me how some people want to pass down the business to their children, but they never give their children any exposure to what the business is. If you bring your children in and you bring your spouse in early into the business and to understanding the ins and outs of the business, they're more likely to want to take it over when you're done. The second reason you want to do this is because when you hire your family on your board of advisors, you are able to have board of advisor meetings anywhere in the world. So you are able to have quarterly board of advisor meetings with your board of advisors. And if your board of advisors are your family members, well, guess what? Thanksgiving, it's not Thanksgiving. We're going to travel to Hawaii for Thanksgiving, and we're going to have one of our quarterly board of advisor meetings then, right? For your family trip in the summer, that's not a family trip. You're taking your kids to Barcelona for the Q3 board of advisor meeting. Right? So now the family vacations that you have or the family holidays that you're paying for anyway, they become board of advisor meetings. And that means that the entire experience is a tax deductible expense. The flights are 100% tax deductible. The hotel is 100% tax deductible. The Airbnb is 100% tax deductible. And the meals that you have catered, right, are 50% tax deductible. Now, if you're going to do this strategy, documentation is so important. You need to document the meeting minutes. You need to take photos of the board meeting, and you want to put this in your corporate book, right? So because if this strategy is amazing, but it only can be executed as well as your documentation. So we recommend documenting the meeting, taking photos, and keeping these in your corporate book so that you can have legitimacy with this strategy, okay? Now, number 5 is amazing because with bringing these strategies together will allow you for strategy number 5 to be as powerful as it can. And strategy number 5 is called the QBI deduction. Okay, this is a deduction that will allow you to write off up to 20% of your business income just for being a business owner, right? So the qualified business income deduction says we're going to give you, the business owner, and this works for S Corps or LLCs, we're going to let you write off 20% of your taxable income just for being a business owner. Here's the problem with the QBI deduction though. If you're single, earning more than $191,000, you are phased out. And if you're married earning more than $383,000, you're phased out. So what ends up happening is some of our clients and some of these small business owners out there, they make too much income to qualify for the QBI deduction. So they miss out on a 20% write-off, right, of their taxable income. So how do we fix this? Well, if you implement strategies, number one, that I just talked about with the salary optimization, if you implement strategy two that I talked about, which is the retirement plan double dip, if you implement strategy number three, which is the Augusta rule, if you implement strategy number four, which is writing off your board of advisor meetings, these are all tax deductible expenses that's going to lower your AGI. It's going to lower your adjusted gross income. And if we lower your AGI with these strategies, we bring you within the income limit to take advantage of the QBI deduction. So, quick story with the client. They were married, and they were married filing joint, and their AGI was $450,000. So they missed out on the 20% QBI. Well, they were going to miss out on the 20% QBI deduction. But when we implemented the tax saving strategies that we just talked about, we got their income from over $400,000 to under $350,000, right? So their taxable income was now $350,000, which allowed them to qualify for the 20% QBI deduction. And if we do the math on that, 20% of $350,000, that's a $70,000 tax deduction, right? So we were able to increase their deductions by an extra $70,000, which at a 37% tax bracket means that we help them save over $25,000 in taxes by implementing these strategies. And this is the power of tax strategy. This is the power of working with a great tax strategy team. And if you're missing a team, all you gotta do is let us know in the comments. Like if you wanna work with an advisor or a tax strategy team, drop the word advisor in the comments. We'll send you a link to book a call with our team. But it is so important. So small business owners out there, you don't have to pay more in taxes than you legally owe. Okay, like we all should pay the minimum that we owe, but let's not leave a tip. Okay, let's not leave a tip. So if this was helpful, if you love this strategy, guys, click that subscribe button and let me know in the comments which of these 5 was your favorite strategy. And again, comment the word advisor in the comments if you want to work with this tax strategy and advisory team that's going to help you maximize your income by minimizing your taxes. And I'll see you guys next time.